first off, a lot of really great conversations lately, and I do a lot of thinking, obviously, as a mentor, teacher, trader. You guys know me, always trying to find ways to help people better in teaching and whatnot. One thing I've been thinking about is the idea of equity and when it's appropriate and what it's used for, and also portfolio insurance. The entirety of this conversation is going to be called portfolio design. Okay, an options traders and guide to structure, I guess. I guess I don't need a subtitle. Portfolio design. Now, the idea here, guys, is under portfolio design, and let me throw this out there to the group, what can we use in our portfolio? Okay, well, we've got stocks, we've got equities, right? We have options, okay? We have futures, we have Forex or currencies. We can actually hold currency, including cash in the US dollar. We can also use commodities, okay? And I'm going to put a big word in here, insurance. Let's start with each of these one at a time. Now, is there anything else I'm missing? Bonds or fixed income, right? Okay, fixed income type stuff could also fit in there. Could we put real estate? Okay, absolutely. Now, and I'm not even talking from an REIT. There you go. Okay. Gold and silver. So under commodities, I would say that. Now, most investors in their IRA, in a trading account, they're going to tend to focus on a couple of these things. Let's first start by circling the ones that are very, very common, or maybe just underlining them. Equities, options, futures, Forex, different forms of currency depending on how you got it set up. You might be holding cash. Definitely currency is important. Commodities tend to happen, physical in your life, right? Because the other version of commodities, the paper commodities, they fall into something above. But commodities, most don't really hold insurance. Some do hold fixed income, but when it comes to trading, I don't see that as often. Real estate or REITs, maybe, maybe not. I'm not crossing them out as a way to say don't do it. I just don't see it very often. I would say the number one thing I tend to see equities. Okay, equities. And so let's talk about portfolio design and portfolio curves and ideas on how to play equities. Now, you got to have a plan in life. Okay, you don't want to jump into the pool and then hope that there was water in there. Not a good plan. Equities for your retirement. What's appropriate? Let's talk about different forms. The ETF market is diverse, broad, and very good. If you don't, and by the way, I'm generally talking about traders and investors who have some money. I'm not really talking about the brand new investor who's starting from scratch. They're going to build up their portfolio in a different way. But what if you do have capital and you're trying to figure out, well, how do I use it, Tim? We're at or near an all-time high, right? Okay, we are at or near an all-time high. And let's see here. Yep. So the ETF market, what kind of ETFs are there? There's a lot out there, guys. There's a ton. Let's open up Google Chrome. I'm going to show you a couple of things. ETF database. This is a website I've used before, simple website. They actually come up in the Google searches. Whoever is running their SEO department must know what they're doing because, man, they come up first whenever you Google ETF. Okay, the ETF database is good. I also like this tool called Yahoo Finance ETF Finder. Okay. Now, check. Where is... It's not searching. Yahoo Finance ETF Finder, Google Chrome, go. And there we are. Spinning. I was on the podcast last week and I was singing to Matt. Did anybody hear that one? It was annoying and pretty good. He did not. It was funny. I've got the spin of death. Look at this. Not good. What's going on here? All right, back here. Let me look at ETF. Actually, why don't I go to Google? See if I can even bring Google up here. Slow. I don't know why. Hold on. Tackle trading. I got all kinds of stuff. These are working. Spin of death. See you later. Let's try this one. 5 bars. Good Wi-Fi connection. You guys can hear me. I do not know why it wouldn't work. It's probably this old HP computer. We'll come back to it. Back to content. Okay, different forms of ETFs. Now, obviously, you have ETFs that they're basically what I like to consider the idea trades. You know, you have inverted, you have regular ETFs. You have inverted ETFs. And you have leveraged ETFs. If you're going to trade any product, you need to make sure you know what you're doing. You need to make sure that you know exactly what is in that product and what you can look at when it comes to that product. ETFs, you have regular ETFs, inverted ETFs, and leveraged ETFs. Which of those that you're going to trade and why is very, very important to make a decision on. Even at Thinkorswim in the scan tab, by the way, let me show you something. If I want to run a scan, okay, I can filter this so where it's looking in the public list called all ETFs. Okay, so now anything I scan for will now filter it through the ETF market. Very important. Okay, I can put in 1 million volume. Even that right there is going to give me 1, 2, 3, 4, 5, and one more 0. Going to give me a minimum standard of what these ETFs out there that I can look through. There's 152 that trade 1 million or more in volume. I can also do some other basic stuff like, let's see, mark. You know, if there's a certain price that I want to operate in. You know, possibly I don't want to trade the little $5 one, so I'll go minimum of $10. You know, scan a few of those out. Okay, very possible that I want to look at up or down that day. I could do. You know, and you don't want to do any the fundamental filters, by the way, because the fundamental filters aren't applicable to ETFs. So I might do something like a vol index and make sure we're above the VIX. The VIX right now is about 14, so I'll say 15%. Okay, filter out. Now there's only 102. So now I could go through these ETFs to get an idea of which ones I might be interested in. You can save those scans and load them up over in your watch list. Okay, save scan query right here. And I could just call this one liquid ETFs and save. Okay. Oh, it already exists, so I don't necessarily need that one. Let's go take a look at which one I built over here. Already called liquid ETFs. HIJK personal liquid ETFs right here. Now, by the way, in Thinkorswim, you know something's a scan if when you go into your personal list, it has that little insignia next to it. Dogs of the NAS, credit spread candidates, cash flow bullish, 50 plus covered calls, stuff like that. I run a lot of scans, obviously, you know, teaching labs, teaching classes, that kind of thing. I'm going to run more than a lot of people, but you don't have to have everything out there. And then what you could do is you could spend a good Saturday. A nice Saturday. Sounds like a good thing to do with your Saturday, especially on one of these cold Saturdays coming up. And you could go through each and every one of these just to see which ones look like what, okay? Now, a couple things to remember. These columns can be customizable. So if you're in here, by the way, you can click this little gear button and customize these columns. Little bits of information like implied volatility. Sometimes I like that in there. Sometimes I want the ATR in there, you know. Things like that, you know. So you can customize the columns with any of the indicators and add them in, okay? So I can organize based on ATR. This will tell me which ones are moving the most. And then I can go through them one at a time. All right. Now, that's great. But that's just his old school thinking, right? Tim, you tell me to go out and play the whole technology market or ETF market or SPY. That doesn't sound real exciting. Well, who said that you had to be excited all the time? You know, if you if you want to be excited, you know, go outside and high five a stranger. In the investing market, you got to be smart. You have to be, right? There you go. Play blackjack or something. You have to be smart. You have to be prudent, and you have to make sure that you have a business structure. For most investors, I recommend the top two here, regular and inverted ETFs. Leveraged ETFs can be a way to hedge. They're not great when you're new, and they can be complicated. So I would be cautious there until you become an intermediate or an advanced investor. Now, let's see if I can get this to work here. All right, Google, ETF, Yahoo Finance, ETF Finder. Look at that, it's right there, ETF Center. Okay, I like this tool. I may have shown you this tool in the past. It's very possible. If I have, some of you may have not seen it or just need a good refresher. Okay, Yahoo Finance, ETF Finder. Now, the reason I like this is that you can click on the category and you can look at different regions in the market. Guys, so many times in trading, we read in the news about an area of the market, something like that. You know, real estate, or government bonds, or China, or the healthcare, or whatever it is. I think every one of you should take a Saturday and go through and pick out your favorite ones. Now, let me show you how to use this. Essentially what you do, let's say that you want to go look at the healthcare area, okay, sector. Click on health. It will then bring up a list of all the healthcare stuff. Show you the intraday return, the 3-month return, the year-to-date return, so on and so forth. If we click on trading volume, right here, okay, here we are, XLV, XBI, IBB. Look, these 18 million, 5 million, 2 million, 3-month average on volume. Generally, you'll get the highest volume at the top, and these can be the starting of your ETF watch list. I don't care which ETFs go on your watch list. I just want you to have one. You know, you need to start thinking about building positions in the equity market. So ETFs, I do like ETFs. I got to tell you, the longer I do this stuff as an educator, even little things can be super powerful, okay? Super powerful. Like the ETF market, for example, guys, just the switch or the transition from mutual funds to ETFs can generally empower an investor in some of the, you know, I would say it puts you in the top 5% to 10% of retirement account holders out there. Because so many people are still just paying fees to mutual funds. They don't realize the power of being able to do this themselves, okay? So how do we position size that? How do we determine how much money to put in each one? We'll talk about that in a minute. Other types of equities, okay? Well, obviously we have stocks. And actually, move this over here. Stocks. Companies. I was recently talking to an investor, and I was looking at their portfolio. and they were looking for some advice, some direction, that kind of thing. And I looked at their results over the course of 5 or 10 years, and 15, talking about the results over 15 or 20 years. And it struck me that I've had this conversation before. New traders tend to think that stocks are a bad thing for some reason. Oh, you don't want to buy a stock, Tim. That's a bad mindset. It's not a bad mindset. Owning things is not a bad idea. Okay, I'm not saying go out and rush into the stock market when it's at an all-time high, but what I'm saying is if you thoroughly do your research, I got to tell you guys, some of the most successful investors and traders I've ever met, they buy and hold companies. Now, does that mean I'm recommending ignorance? No, of course not. No, I'm recommending thorough research. I'm recommending thoughtful decision making. I'm recommending an organized plan. I'm recommending to reconsider your mindset if you convince yourself to never trade a stock or never own a stock or never hold a stock. I actually think it can be very powerful, especially for a trader, to go out and have to think about buying, have to think about research, have to think about where things are in the marketplace. Now, generally, stocks can be in different kinds. Could be that you go out and you position yourself in pretty small. Stock positions can range anywhere from 1% to 10% in some portfolios. Now, 10% might be super aggressive, but I can think of situations where somebody might be in the SPY or the QQQ. Or something that they're comfortable with 10% of their portfolio. Guys, you got to come up with a plan for yourself. The reason we're having this conversation is so that you can think about position sizing, portfolio allocation. Because at the end of the day, even a great option trader has a hard time getting all their money to work safely. If you've got a portfolio, you probably have room to consider stocks or ETFs as a way to kind of build and base that portfolio. Now, requirements, characteristics that I think are very important to have with any of these. I like them to be optionable, liquid, and I like to look for strong management in a sector or industry that I believe is in a good position in the economy. I like to scale in, and I like to be able to use covered calls. That's a good consideration with these, okay, and that kind of thing. Now, a lot of different reasons why we go out and buy certain companies, isn't there? But I don't think anybody's going to ever convince me that owning a company is a bad idea. Now, you might think, well, Tim, what about leverage? Why can't you don't have to use leverage all the time. Leverage is a powerful thing. We have it. Okay. It also, by having leverage, it allows us to use some of our capital in other ways. So it's something to think about. If you've not bought, when's the last time you guys bought a new stock or ETF? Okay. Let me ask the group. When's the last time one of you guys bought a new stock or an ETF? Long time ago, back in March. Within the month, today, Shaolin. Okay, good. Now, this is a direct reflection of activity and aggression. Apple got put to you. Well, it's had a little recovery then, though, hadn't it, Dean? I mean, it's back up to 120, so it's been a little nice. Yeah. It's. I just got to tell you, I mean, it's my job to be direct, to be helpful. Thank God I don't have to be musically talented, because I can't carry a tune. But I would be remiss if I was not just direct. Okay, I think that more option traders should come up with a conservative approach, also long term for other accounts. You don't have to be super aggressive in everything that you do. Okay, you just don't. There's nothing wrong with owning equity. And I'll tell you one thing that it did for me. And when I was new to trading, I was taught, well, you got spreads, you got this, you got that. And I was told, I mean, don't buy stock. That I was told that. And I was a young man. I was 25 when I started. I took mentorships when I was 26, 27. I understand what they were telling me. You know, well, you've got this skill set. You can go out and do other things. The longer I do this, it's kind of nice to have some positions that you own. I do like having that, you know. That way you're not always fighting to get your money to work in a marketplace. Okay, we'll get more back to this in just a minute. Equities. At some level, you've got to consider equities. How are you going to build your portfolio? You can do it with the ETF market. You can do it with stocks. You can do it with a combination of both. Gives you some potential to do some cash flow as well. We'll get back to that piece in a minute. Options. Now, options, you guys trade options. You guys know options. If you're out there and you're listening to this on replay or something like that, you might be thinking, well, Tim, what strategies can I use? It generally comes down to one of two types. You're either going to get into cash flow, one of three types, I would say. Speculation, okay, or specialty. Now, the longer you trade options, you tend to like to do all the little creative ones. They're very, very cool. But you know, a lot of portfolios, I could see allocations where the equities in a portfolio should be somewhere between 40 to 80%, and the options might only be somewhere between 5 to 30%, okay? Depending on the nature of the aggression and how good you are at it and that kind of stuff. See, some portfolios are designed entirely with derivative products, options, futures, forex. Those should be the top level of trading. Those are great systems. I do like them. But I'm talking also about retirement accounts. Not everybody out there can do that. Not everybody out there can get $1 million or $3 million to work all in the options market. It's too aggressive. It's not the right approach for every investor out there. And so you got to think to yourself, whether you have it now or you're going to have it later, how am I going to treat my money once I get some more capital working? Am I going to keep my systems just full blazing ahead, or how am I going to grow long term while also protecting? Okay? I'm a believer that cash flow should be a priority in any options portfolio. It's a personal opinion. It's not dead in a stone. It's not locked in there. Some people decide to do more specialty techniques. I'm open-minded to it, depending on your skill set and your personality. But you've got to really sit down and think, how much capital am I going to put into a trade? Okay, how much capital am I going to put into a trade? It comes back to reward, risk, and probability. And if you're risking more than 4% of your portfolio in a position in the way that it actually performs, then you've gone too far. Okay, you're overly aggressive. So think about your option trade. You know, think about your maximum theoretical loss on your option trade. Look back at your results over the last year and ask yourself, have I ever hit that? Okay, has it happened to me? Was it an anomaly, or am I over leveraged, into some of these options positions? I'm a believer, guys, that if you do this stuff the right way, it's all powerful. It's never fun to have an old veteran trader get up in front of you and say, hey, be more conservative. I get that. But the reality is, I am all about safety, cash flow, and I think everything else kind of takes care of itself over time if you've got those two things, okay? And so just some thoughts here. With options, we have to design kind of how much we're allocating, but then we also need to consider how much per trade, okay, and how we build that. You probably need to sit with a mentor, talk to me or something like that if you still have questions regarding that. The futures market, I think it's important to have access to futures, some for speculation, okay, but also hedging. Futures are one of the best hedging products available. If you don't know how to beta weight your portfolio and figure out how to trade an ES contract to protect yourself, I think that you need to work on that skill set. That is very important, okay? One ES contract for every 500 delta points against SPY, by the way. So one ES contract for 500 delta on SPY if you're beta weighting. Now, if we look at Thinkorswim, for example, we go to monitor, we beta weight here, we put in SPY, Well, look at this. I've got negative 500 delta on this RUT position. Got negative 281 on Amgen, right? Got some negative delta in here. I'm waiting for these things to come back down. Now, I might need to go to the old layout and take a look at the whole kit and caboodle, okay, and add all these numbers up. So let's say I need to do one ES contract. Well, these two letters, Solon, you were asking earlier, what that is that's just your expiration, okay? So when you trade a futures contract, if you look at the, let me find ES or CL or any of them. Man, I swear, we should make an independent movie called Waiting for Data. It'll be all about, I don't know, you tell me the plot line, Dino. All right, ESZ5, ESH6, ESM6, ESU6, all over. So you can trade any of these different ones. They'll default you to the active contract, so that's what that is, okay? Yeah. All right, okay, charts. Okay, so back to our thought. Let me kind of rewind here for a minute. We're having a general conversation about portfolio design, okay? Gotcha, T. Make me laugh. All right. Hey, I'm glad we got no kids in the audience, Dean. That was not a PG-13 movie script. Okay. Equities, options, futures, forex, currency, and commodities. The relationship of what you put into different areas of the market is going to really dictate how you trade, obviously. But you got to put some thought into this, and you really got to look hard and say, okay, how aggressive do I really need to be with my capital? What is my goal? I really think security is a goal. Okay. Now let's talk about futures. Using futures to hedge is the minimum thing you should be able to do. You might also be able to trade them. You know, it depends on your portfolio size. I like the crude oil contract. I like the metals contracts. I do like the E-mini contracts as well. But those are more directional trading. They can be swing or position investing, but you have a lot of leverage when you trade a futures contract. So you don't really need that many of them usually. The other area, okay, it's moving on here. The other area is currency. Now, most currency hedging can happen with the DX contract, okay, /DX. If you've got cash in your portfolio, okay, so when I'm saying currency, we do need to know how to hedge currency with futures. That is the DX contract, okay, and in general, one DX for 100K in cash is kind of what you can do there. Now, if you're also, if you get to the point where you've generated and accumulated some wealth and not everything is in that, you might want to actually pick up different currencies to hedge. You know, actually own currency. Not a bad idea. I like the pound. You can do it in a Forex account a lot of times. Cross-pair trading, that kind of thing. You can do some hedging. That's a completely different piece. But you do need some cash. In general, I would say cash requirements on most portfolios, it needs to be somewhere between 10% up. Now, up means as much as you need. If you're truly worried about the marketplace, is it wrong to be 75% in cash? Is that the worst position I've ever heard? No, it's not. If you don't know what else to do, cash can be a location to start with. It's not a good long-term plan, but there's nothing wrong with going to cash at times when you're concerned. Okay, that all fits inside the Forex and the currency piece, and you can hedge it with the futures market as well. Now, commodities, my thought here, quite frankly, is actually the physical commodities. You know, if you've never bought one of those big boxes of silver or some gold coins or whatnot, I think that might be in your future, and that might be something you might want to look at as well as a way to hedge off some of the risk you have. See, portfolio design requires a lot of these different areas, right? Okay, you know, a lot of these different areas. And you got to have a plan long term. I'll give you an idea of a strategy. One thing that I like doing is, let's say that you take 10% of your profits and buy physical with it. Would that be a bad plan? Okay. Would that be a bad plan? You have a good month, you go out and you take some of your money, you go buy physical with it to hold value. It's not a bad plan at all. Okay. Same regard, this will actually appeal. What if you take 10% of your cash flow and buy insurance with it? Is that a bad plan? Not at all. Now, and this is where we get into the last kind of area I want to talk about. Real estate can hedge, but insurance. To hedge $1 million of SPY, just bull market ETF, how many delta points do we need? Okay. Let's bring up the SPY. Let's think about this. If I've got a retirement account in the market, let's say I'm in stocks, and I know you're not going to usually just be in one ETF, but let's just go with the example here to give you an idea of what we're talking about. If you're in ETFs or stocks or shares and you beta weight the delta and you go out and you look at it and you say, okay, Tim, well, if you have $1 million of SPY, that means that $210 price, let's clear this out, $1,000,000 divided by 210, that puts me at 4,700 shares. Well, to buy options insurance against SPY, usually we're going to be looking out a couple years for investors. January of 17 would put us at a delta, let's say just out of the money, like 30 delta, 31 delta, something like that. Okay, these are $1,000 a piece, okay? And they're only 31 delta. For me to get to 4,761 delta, I would need to take the 190, divide it by 30. I would need 158 contracts. That's not exactly an easy pill to swallow, is it? When you think about it. Like, Tim, how am I going to afford that many contracts? Well, we can buy more delta with a little higher price, or you can come up with a long-term strategy. If we look at a risk profile and we consider simulating 4x times 30, something I was thinking about over the weekend. Let's say we simulate 4,761 shares. Okay, we get into $1 million portfolio here, and 4,761. Okay. And then I simulate the long-term leap options at 190. It cost me $1,000 a piece to buy them. Now, by the way, how much can we cash flow on $1 million? How much could we cash flow on $1 million? Even covered calls, conservative stuff. Okay. How much could we cash flow on $1 million? Well, the December 47-day option, slightly out of the money. We can do a lot, right? 47 contracts. I mean, my extrinsic value alone, let's take this, $300 times 47 contracts. That'd be pretty decent, just on cash flow. Okay. Well, I'm trying to do some math now. 3,000, 12,000. Do a lot. We can probably do a lot more than that because we'll also be in shares and all that kind of stuff. So, what if every time we made money on cash flow from selling options, we took some of the money, whatever that amount is, we take some of the cash flow and buy insurance? Well, eventually, watch this, guys. Let's do it 10 at a time. Okay. 10 grand. Okay, 10 grand on $1 million, only 1%. So we're into it 1%. Now we're into it 2%. 30 contracts puts us in at 3%. 40 contracts puts us at 4%. 50 puts us at 5%. 60, 6%. Now we're tipping the scale. Look at that. Okay, look at this. Now we're protecting. Okay, what if we can get to 7%? What if we can get to 8%? What if we do this over time as a way to protect the assets in our life? Now you might be thinking, Tim, 8% is 80 grand. How am I going to take 80 grand of my portfolio and buy insurance? You know, man, I need that money. That's cost. Well, you don't buy insurance because you think you got to turn it into a profit. You buy insurance because you know it's probably going to cost you. If you truly are concerned about where the economy is, I'm going to give you a couple of guidelines on this insurance thing. Okay? Whatever the number is, when the VIX is low, insurance is cheaper. Okay? Buy it for protection with profits when times are good. Now, there's a couple of little things to think about here. 5% is pretty traditional to insure a portfolio. 10% is pretty aggressive to insure a portfolio. But why would you wait until the market goes haywire? I mean, why not start accumulating it slowly? You know, one of the most intimidating things, I think, for a new investor is the idea that you got to go out and buy everything all at one point, right? What if you just decided that every week you'll get an extra one of those contracts, and you'll always keep them a long time out so that you don't have any time decay or anything like that? Do you think that would give you a lot more peace of mind if you're trying to protect a portfolio, to actually be in some insurance as well? You know, guys, I got to tell you, I've got a different perspective on this. I've had a lot of clients in my office over the years, and I enjoy doing this, teaching, being a trader, love all of it. The biggest difference between those with a lot of capital and those with the sob story is how they dealt with the bear markets. Now, I know the market's been going back up. Markets probably should have recovered, make some money on cash flow, make some money on covered calls, make some money on all that kind of stuff. But if you don't come up with a plan on how to protect yourself, you know, in many different regards, in a trading strategy, whether it's a covered call or a spread, or in a portfolio strategy, which, by the way, is more important. You got to have a long-term portfolio strategy. I think eventually you'll end up being a victim to it. I don't know when the market will go down. It may not go down, for all I know. But I do know this. If I'm active and I'm picking up 3 or 4% a month, 5% a month if I'm doing great, maybe even more if I've got good systems, you know, in cash flow, why can't I divert 5 to 8% in insurance? Can somebody give me a good reason? Can somebody give me a good logical reason why you can't divert some of your profits into the insurance side of it that you don't have to micromanage? Now, you might be thinking, well, Tim, can't I just buy it when I need it? You can always buy a little bit more. But if you get it when the VIX is low, you're getting it cheap. Okay? Do you have to go out and buy everything in one shot? No. Okay? So, just a thought. And you can do some things like with that. Generally, Paul, when you're looking at the insurance market, that's some good questions. How far out? Well, it depends on how you trade. What I'm talking about here is for the trader who does cash flow, but they're putting the insurance on so they don't have to micromanage it. These ones, we went out a long ways. I'm almost 445 days out. I think you could easily use the September. You don't have to buy the same month and strike over time. This idea is for a portfolio to be able to hold it, right? You know, not necessarily use it to get out of it right away. So you're building it up over time. Now, by the way, if we ever do hedge the entire delta on that, if you end up getting enough insurance to where it's like 180 contracts or something like that, okay, now you actually make more money if the markets crash. You know, so that is something to think about. I probably wouldn't overinsure that unless I was hedging. Here's my thought. and this gets back to the insurance piece, if you can buy some long-term stuff to give you a little bit of comfort, but then you can also add futures to overhedge when needed. Does getting put options long-term prevent us from playing the ES bearish if the market breaks down? No, it doesn't. Does it prevent us from hedging delta and short-term risk? No, it doesn't. Does it prevent us from using these put options for a lot of different things like cash flow themselves and all kinds of stuff? Yeah, absolutely. See, and could we even, if we knew how to trade and we were patient and we read a signal right, could we even take these off a little bit at a time when we have profits? Yeah, okay. This mindset is basically this. You take insurance, or actually let's do it like this. You take equity. You use options in whatever ways you want to use them. You also consider commodities and whatever other is, like currency. Okay, and you take your asset classes, the things that you're investing in, and you use your systems as a way to also, on the outside of all of it, have an insurance model over time to make you feel a lot more comfortable. Okay, to review, portfolio design is something each and every one of you need to really sit down and think about. I think that you've got to have some exposure in all areas, even if it's something small when you're getting started. Maybe you just go down to the coin shop and pick up something physical, or you learn just so that you can get exposure to it, or you buy one put option out there as your first one to play, or whatever it is. It doesn't have to be all, the whole kit and caboodle on the first time. Obviously, it takes time to build philosophy behind your portfolio. Consider equities. I do like equities, especially for cash flow from covered calls, things like that. And then as you build cash flow and profits, use it to protect yourself. You don't have to just put every penny you make in your pocket. Some of that should actually be to protect your long-term capital. Because if you have built wealth, and every one of you are on your way, if not already there, if you have built some wealth through equity and commodities and trading and options, and you got currency, you've got to have a plan for what you're going to do with it. I had a trader tell me once, a very good mentor of mine, say, Tim, you can make money, but if you don't learn how to keep it, it's not going to be great. So you got to learn how to keep it as well and protect it. Now, that being said, do I think the economy's ready to just tumble? And I don't know, guys. We've talked about that 100 times, 1,000 times. I do think all the risks that we've been seeing are still there. I think that the market could easily go up. It can stay illogical. What's that old phrase? Longer than we can stay solvent, right? If you're just betting against it. And who knows? I think as you're looking at the end of the year, you got through a Fed meeting. You don't have another one for 6 weeks. We have central bank decisions around the world this week as well. Got a lot of stuff going on with the currency wars. I still think there's a lot of problems fundamentally in the economy as well. That's why it's more of a let's make sure we're protected long term. Now, do we need the 453-day option? Not necessarily, but they're cheap. You don't have to. The shorter you go, the more time decay you're going to deal with eventually. Depends on your strategy. And all I'm saying is have a strategy and make sure that you've designed your portfolio with rules. Okay? All right.
Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.